What really happens to a 401k in a business sale?
Today we're covering exactly what happens to a 401k plan when a business is sold and what happens when the plan sponsor dies.
The core problem, the 401k plan is a legal entity separate from the business.
It's a trust.
It's a there's a trust. It is a separate legal entity that can outlive the plan sponsor. When the business sells, the plan does not automatically transfer, terminate, or do anything. Someone has to actively make a decision.
And that is the trustee. That's the trustee.
The trustee and or the plan administrator, capital P, capital A. All right. Most plan sponsors assume the retirement plan consultant or the buyer handles it. Every so often, they even think the financial professional is taking care of it automatically. Guess what? They don't, because they're not plan administrators or trustees.
Now, by the end of this video,
Yep.
you'll know the three options, which one is the most commonly chosen, and which one catches everyone off guard except for Christopher.
Well, I was going to say except for us. Right. Now, when a business is sold, there are three main options.
So the first option is that the buyer assumes the plan.
The acquiring company takes on the plan
As it is.
as is. Okay. There's no warranty. Okay. There's no 90-day free look. You are getting the liabilities of the plan as well. Even if it's not explicitly written out that way, you are. So that's why all of us in the retirement plan consulting community goes, huh? When the buyer assumes the plan, this is going to require a formal plan merger or assumption agreement. Something needs to formally be done to the plan.
And that's really important because the whole idea of that the company was just bought and it went over is not what happens. Like, you're still on the hook for running
Right.
the plan unless you do something.
Right. Now, this is not always available. The buyer may not want the plan. If they've talked to us, they probably don't. The liability or the compliance history. Okay. Now then, if assumed, the participants get now. So there's some option. There's some
continuity
positives
is
to this.
interesting.
Continuity is nice. Participants continue contributing to the plan. All right. Again, after all the proper paperwork has been done. Now, the plan document may need an amendment to align with the buyer's plan year and rules. So, in other
That's
words,
if they have a plan.
that's if they have a plan. Also, because we need to keep this video kind of short, we're not going to talk about the transition years when you're assuming when you're taking over another company. This situation is best when it's a full asset acquisition where the buyer wants continuity. That means it's not a stock sale, because when it's an asset sale, you have the choice of doing this. If it's a stock sale and nothing is done with the plan, you are the new sponsor because you own the stock. All right. Bunch of stuff still needs to be done to make it right. But now then, a flag for the advisors to pay attention to. Extra credit for for our financial professional friends out there and our CPAs. This probably requires ERISA counsel to at least have a look at things. This is not a handshake agreement. Stuff needs to be done properly and in writing. Now then, for you CPAs and financial professionals, if you know about this acquisition before the retirement plan consultant does, that's us, get a copy of the deal. We all have NDAs. Why are we talking about this? Okay, I have to make this purposely vague because it's a client. Okay. The client was telling us about a transaction, and they were telling us the transaction said do left. Okay. So because we were listening to the client, we did all of our paperwork to do left.
To the left.
And then our ERISA attorney and said, slow your roll. I think that's a quote. And said, we've got an NDA. Get me the document. And guess what the document said? The document said, do right.
Yeah.
Oh yeah, the client was absolutely adamant. It said do left, and then when we saw it in black and white, it said do right. So that's why you need to get a copy of the deal. Option number 2, terminate the plan.
Whew, that certainly
see
solves a
this
lot
a
of
lot.
problems.
Okay.
The selling company terminates the plan as part of the conditions of the sale.
Correct.
All accounts become fully vested at termination. I mean, the money's already in the plan. It just becomes
Right. There's
fully
no vesting schedule. You don't get to add anything to forfeitures.
Right. Participants receive distribution options, which are either rollover to an IRA, rollover to a new employer plan, or taxable cash out.
Okay, so this is very important here, because when you terminate the plan, you have a distributable event.
And participants have options.
The participants have options. The thing we were talking about before, all the money moves over. It's not a distributable event. Now then, this does need to be done in a certain time frame. The IRS does really, really want assets to be distributed within a reasonable period, and there are ways to get assets out of the plan if people can't be found. Now then, again, for our financial professionals, pay attention, just so that people understand what's going on. Outstanding participant loans become taxable. Okay, the plan's being terminated. If somebody last week just took out a $50,000 loan,
Yeah.
okay. Even if they're rolling everything else over to an IRA, there's theoretically
Well, they can pay
possible-
it back.
They can pay, if they got 50 grand, they can pay it back. There's the slight possibility that the buyer's plan will allow an in-kind distribution, maybe, but don't plan it. Also, this is a time when people are surprised by the fact that the plan might have a market value adjustment.
Back-end stuff.
Back-end stuff, yeah. Some of the assets may not be liquid, okay? And as we said a few minutes ago, get a copy of the
Deal.
Get a copy of the deal. This is what happens. Option number 3, or situation, it's more situation number 3 happens when there's a partial sale. 1 and 2 when everything's being sold. But what happens if you have a company that's only selling off part? So it's selling off a division or a location or something like that. This one gets overlooked a lot. Now then, if a significant portion of employees are terminated, I forgot to double check the numbers, but the notes here say 20%. The plan may be partially terminated. Now this only affects the people who are part of the sale, not everybody else. The 20% is of the total, okay, but partially terminated affects just the people being terminated. And what are the consequences of this?
Consequence, all affected employees become fully vested immediately.
Correct. So even if they've been there a week, they are now 100%
And this
vested.
happens automatically. It's not a choice. The IRS determines on audit.
Yeah, well, so what we're meaning by that is, I know it happens automatically. The rules say it happens automatically, but unfortunately, that's true in theory. This needs to be managed and paid attention to. Okay, the record keeper or your retirement plan consultant needs to be aware of what's going on. It is not their choice to vest people 100%. And even though the rules apply automatically, you need to make sure it happens, and you do not want the IRS determining this after the fact on audit, because they're going to make those people whole. Now then, most plan sponsors and many advisors are unaware of this. Are there any real consequences to this, dear?
Absolutely. So the employer expects to retain unvested contributions, instead owes those amounts to departing employees.
Or departed employees. Okay, so we've been talking about the living. What happens
To the dead.
when we're seeing ghosts?
Okay.
Keep going.
It's a different scenario. The business may continue, but the plan administrator is gone.
Who takes over?
If named in the plan document, the successor administrator. Do you see that very often? I feel like I don't see that very
have
often.
seen more unicorns in my life. Actual, real, non-imaginary, non-mythical unicorns and big feet than I have seen a successor administrator listed in a plan document. This is why we always ask for more than one trustee.
Give me another.
Yeah. Now then, if not, this is typically, it goes to the estate or the business successor. Okay,
So there is a pathway.
there's rules, but it gets very messy. Yeah, and then what happens is that the owner's account, the dead person's account, okay, is treated like any participant. The beneficiary designation controls the distribution. If there's no beneficiary designation, the plan document controls the distribution, which usually means it defaults to the estate. And we have found out from we know firsthand from a client who didn't do everything correctly, all right, that money going to the estate is not tax-free. You can't roll over to an estate. You can only roll over to a person. Now then, let's talk about the second bullet where it says beneficiary designation controls distribution. Catherine, this is not a trick question.
I'm focusing.
If the plan sponsor has 2 plans,
Yes.
how many beneficiary designation forms do you need on record, Donna?
2.
Yes, you need 2. You need 2. Now then, additional considerations. And this is true for all of them. Outstanding loans. We mentioned this already.
They become due. Taxable.
They are treated as a distribution. Oh, this is true for the dead guy. So treated as a distribution if not repaid by the estate. Okay.
So there is always death and taxes.
If
right?
it's an old person, RMD obligations do not pause. Estate must ensure distributions continue. And the core issues. Most small business plans have no succession for the plan or the business itself. In fact, we even had a podcast guest months ago. You may remember her as Lightsaber Lady, okay, who specializes in these kinds of situations. It can get messy and slow and expensive. Key questions to ask.
Is the buyer assuming or the seller terminating the plan? What way is the plan going?
Right. How many employees are being retained versus let go? Partial termination, partial acquisition, full acquisition, etc.
Is the plan document up to date and ready for review?
We hope
Can you
so.
find it?
Can you find the
You
plan
better
document?
find it.
And are all beneficiary designations current for all plans? All plans of the employer. Now then,
Real cost of getting this wrong. Partial termination discovered years later on an IRS audit. Oh my God.
no, there are back contributions, penalties. I know that people always throw up potential plan disqualification risk. For this, it's going to be really light. And not really light. Odds are going to be slim that this is a disqualification, but stuff needs to get fixed, unfortunately. Now then, if you want to learn more, and we hope you do because you've lasted this long, especially if you're a financial professional or CPA, we have a rather interesting and helpful and educational monthly webinar that goes deeper into the compliance of 401k, cash balance, ERISA plans, everything. Whatever you want to know, let us know, okay? We have that every month.
401k drivers and their prospects.
And if this little diatribe was useful,
Sorry.
our podcasts and other channels are linked below. You know what to do. Like, subscribe, tell your friends and neighbors, tell your people you don't like to watch our channel. Just tell them to subscribe, okay? And most importantly, don't forget to keep those cards and letters coming.
Toodaloo.